Hello everyone and welcome to my channel. My name is Ali Akbar and I am thrilled to present a crucial topic for traders, price action. In this video we will dive into various chart patterns like hammer, shooting star, bullish and bearish engulfing. I will guide you through identifying and drawing support and resistance levels as well as understanding trend analysis, including uptrend, downtrend, trend lines, breakout, pullback, and even false breakout. To ensure your understanding, I will provide numerous practical examples in real time. Whether you are a beginner or an experienced trader, mastering price action can greatly enhance your trading skill and profitability. So let's embark on this fascinating journey into the world of price action. What is price action and why it is so important? Price action can be understood and analyzed through the following steps. Number one, observation. Price action involves carefully observing and analyzing the actual price movement displayed on a chart without relying on additional indicators or oscillators. Number two, candlestick patterns. One key aspect of price action analysis is studying candlestick patterns such as doji, hammer, engulfing, and spinning top, among others, providing valuable information to anticipate potential reversals, continuations, or indecision in the market. Number three, support and resistance. Support is an area on the chart where buyers are stepping and willing to push the price higher. Resistance, on the other hand, is an area where sellers are stepping and willing to push the price lower. By identifying and analyzing these key levels, traders can make informed decisions about entering or exiting trades. Number four, trend lines. Trend lines help traders identify and visualize the direction and strength of the prevailing trend. An uptrend is represented by a rising trend line connecting higher swing lows, while a downtrend is depicted by a descending trend line connecting lower swing highs. Understanding the trend and its potential reversal can assist traders in making more accurate trading decisions. Finally, number five, chart patterns. Chart patterns such as head and shoulders, double tops, double bottom, triangle, and flag pattern provide insight into potential price movements. By recognizing and interpreting these patterns, traders can anticipate breakouts, reversal, or continuation of the trend, thus improving their trading decision. By following these steps, you can gain a deeper understanding of price action and make more informed trading decisions. In this segment, we will be diving into one of the fundamental aspects of price action analysis, candlestick patterns. There are several common candlestick patterns that every trader should be familiar with. Let's begin with the doji candlestick pattern. A doji candlestick pattern like this is a type of candlestick formation that occurs when the opening and closing prices of an asset are very close to each other, resulting in a small or non-existent body. The open and close prices can be equal or extremely close, creating a cross-like appearance. The doji candlestick pattern is often interpreted as a neutral or indecisive pattern, indicating that the market is uncertain about the asset's direction. When you spot a doji on your chart, it suggests that buyers and sellers are in equilibrium during trading period, and a potential trend reversal may be on the horizon. Next, we have the engulfing pattern. Engulfing pattern could be bullish or bearish pattern. First, bullish engulfing pattern. In this graph, the bullish engulfing pattern is formed by two candles. The first candle is a small bearish candle, while the second candle is a large bullish candle that completely engulfs the body of the first candle. When this pattern appears at the support level or at the bottom of a downtrend, it indicates that buyers have entered the market with a strong conviction and are ready to drive the price higher. This suggests a potential reversal of a downtrend and the start of an uptrend. Bearish engulfing pattern. In this graph, the bearish engulfing pattern also consists of two candles. The first candle is a small bullish candle, and the second candle is a large bearish candle that completely engulfs the body of the first candle. When this pattern appears at a resistance level or at the top of an uptrend, it signifies that sellers have stepped in with significant force overpowering the previous buying momentum. This suggests a potential reversal of the uptrend and the beginning of a downtrend. Moving on, we have the hammer and shooting star pattern. First, hammer candlestick pattern. In this graph, the hammer candlestick is a bullish pattern characterized by a small body at the top and a long lower wick or lower shadow. It typically appears at the bottom of a downtrend and suggests a potential trend reversal. The long lower wick signifies that sellers push the price lower during the trading session, but buyers manage to regain control and push the price back up. This pattern indicates a shift in momentum and a possible uptrend reversal. Shooting star candlestick pattern. In this graph, shooting star is a bearish candlestick pattern that mirrors the hammer but appears at the top of an uptrend. It has a small body at the bottom and a long upper wick or upper shadow. The shooting star suggests a potential reversal of the uptrend and the start of a downtrend. The long upper wick indicates that buyers initially push the price higher, but sellers enter the market and push the price back down. This pattern indicates a change in sentiment and a potential shift toward a downtrend. In this segment, we will be exploring another crucial aspect of price action analysis: support and resistance levels. But first, how to identify and draw support levels. Support levels are essential tools for analyzing price movements. Support is a level on the chart that acts as barriers where buying pressure dominates, halting the price from falling down further. Let's take a look at the daily chart of BLDP stock as an example. To draw support levels in this chart, we search for areas on the chart where the price has changed direction multiple times. These areas can be identified by observing instances where the price has either bounced off a specific level or encountered difficulties in breaking through it. To determine support levels, we focus on significant swing lows, which are points where the price has previously reversed and initiated an uptrend movement. We draw this horizontal line connecting these swing lows to visually represent the support level. It is crucial to remember that support area are not exact lines, but rather zones or areas. Therefore, the line we draw should encompass as many significant swing highs as possible. This is how we identify and draw support levels. By identifying support levels, we gain insight into potential areas where price may reverse, consolidate, or break out. This knowledge helps us make informed trading decisions and manage our risk effectively. How to identify and draw resistance level. Resistance levels play a vital role in analyzing price movement. These levels act as a barrier on the chart where selling pressure dominates, preventing the price from further upward movement. Let's examine the daily chart of FL stock in the D1 time frame to understand this concept better. To identify resistance levels, we look for areas on the chart where the price has repeatedly changed direction. These areas can be recognized by observing instances where the price has either bounced off a specific level or encountered difficulties in surpassing it. Our focus is on significant swing highs, which are points where the price has previously reversed and initiated a downtrend. To draw resistance levels, we connect these significant swing highs using these horizontal lines. These lines visually represented the area of resistance. It is important to note that resistance levels are not exact lines, but rather zones or areas. Therefore, the line we draw should encompass as many significant swing highs as possible to capture the broader resistance zone accurately. By identifying and drawing these resistance levels, we gain insight into potential areas where price may encounter obstacles, reverse its direction, consolidate, or potentially experience a breakout. This knowledge empowers us to make well-informed trading decisions and effectively manage our risks. In this segment, we will be exploring a crucial aspect of price action analysis called trend analysis. Understanding trend is essential for identifying the overall direction of the market and making informed trading decisions. So let's get started. How to draw and identify an uptrend using trend line. When it comes to trend analysis in price action, the first step is to identify and confirm the direction of the market trend. Let's take a look at the daily chart of GameStop Corporation as an example. To identify an uptrend, we need to observe a sequence of higher swing high and higher swing low. This means that each peak high in price is higher than the previous peak, and each true low is higher than the previous true. An uptrend indicates that buyers are dominating the market, resulting in uptrend momentum. To draw the trend line for an uptrend, we simply connect all the truths that lies on a straight line, just like this. This line is called the dynamic trend line, which acts here as support area. If the price consistently stays above this trend line, we can confirm that the trend direction is upward. By understanding these concepts and observing price movements, we can effectively analyze trends and make informed trading decisions. How to draw and identify a downtrend using trend line. When it comes to trend analysis in price action, the first step is to identify and confirm the direction of the market trend. Let's take a look at the daily chart of CL stock as an example. To identify a downtrend, we need to observe a sequence of lower swing high and lower swing low. This means that each peak in price is lower than the previous peak and each throw is lower than the previous throw. A downtrend indicates that sellers are in control and market experiencing downtrend momentum. To draw the trend line for a downtrend, we simply collect all the peaks that lies on a straight line just like this. This line is called the dynamic trend line, which acts as resistant area here. If the price consistently stay below this trend line, we can confirm that the trend direction is downward. By understanding these concepts and observing price movements, we can effectively analyze trends and make informed trading decisions. Now let's discuss the significance of breakout, pullback, and false breakout. First, breakout. Breakout occurs when the price successfully breaches a resistance or support level, indicating a potential continuation of the trend or a new trend formation. Breakouts can provide excellent trading opportunities as they often lead to a strong price movement. On the other hand, pullbacks occur when price retraces temporarily after breaking out of a support or resistance levels. These pullbacks allow traders to enter trades at more favorable prices before the price resumes its direction. Pullbacks can act as opportunities to join the trend or add to existing positions. By combining breakout and pullback scenario with support and resistance levels, traders can develop effective strategies. For example, when the resistance level is broken, traders may wait for a pullback to the broken resistance level, which now act as support before entering a long trade. False breakout refers to a situation in financial market where the price of an asset briefly moves beyond a significant level of support or resistance, leading traders to believe that a new trend is forming. However, the breakout turned out to be false because the price quickly reverses and retreats back within the previous range and put traders in calls, resulting in lost trade. To solidify our understanding, we will dive into practical examples that illustrate the application of these concepts in real-time market scenarios. How to trade shooting star candlestick pattern. In this example, using WCP stock and daily time frame, we absorb an uptrend following by a strong shooting star formation at the top of this uptrend, indicating a potential reversal from uptrend to downtrend. To confirm the reversal, we have to wait for the confirmation candle. And this bearish candle is the confirmation candle that closes below the low of this shooting star. So then we can exit the trade at the close price of this confirmation candle and put 1 ATR above for stop loss and 2, 3, or 4 ATR below for profit target. Alternatively, we can use a stop loss placed at 1 ATR above the high of the shooting star. By using this information for this confirmation candle, then this is going to be our stop loss and this is our profit target. So this is how to trade shooting star candlestick pattern. How to trade a hammer candlestick pattern. In this example, using a daily chart of WCP stock daily time frame, we observe a strong downtrend followed by a hammer formation at the bottom of this downtrend, indicating a potential reversal. To confirm the reversal, we wait for the next candle to close above the hammer's high, this bullish candle. So our stop loss is going to be set at 180R below the low of this confirmation candle for a stop loss, and we can put 2, 3 or 480R above the high of this confirmation candle for profit target. So basically this is going to be our stop loss and this is going to be our profit target. We can also put our stop loss 180R below the low of this hammer. So this is how you can trade a hammer candlestick pattern. How to trade a multiple inside bar combo based on a daily chart of K stock and daily time frame. The initial trend is heading upward, as you see, followed by a minor pullback. The upward trend resumes, accompanied by a significant bullish candle. You see, this is a very strong bullish candle known as a bullish Marabozo, indicating a strong momentum. At the peak of this uptrend, a large bullish candle acts as a mother bar, followed by a long leg doji and 3 bearish candle, consecutive bearish candle, all of which are inside the previous candle's range. All of them, they are within the range of this big bullish candle. To confirm our decision to exit the trade, we observe the fourth bearish candle. This is the fourth bearish candle, which breaks out of the inside bar, as you see, inside bar pattern. We can exit the trade at the open price of this candle, the fourth candle. For risk management, we can set the stop loss 180R above for a stop loss, and we can put 2, 3 or 480R below for profit target. So this is going to be our stop loss and this is going to be our profit target. Then this also the information for this bearish candle. That is how to trade a multiple inside bar combo. How to trade bearish engulfing pattern. In a daily chart of EXC stock, there is an initial uptrend. You see the trend is going up, and at the top of this uptrend we have this bearish engulfing pattern that suggests a possible trend reversal from uptrend to downtrend. To confirm this reversal, we wait for the subsequent candle to close below the low of this bearish engulfing. You see this bearish candle that closed below the low of this bearish candle in engulfing pattern. So we can exit the trade at the close price of this bearish candle, and we can put 1 ATR above for a stop loss, and we put 2, 3 or 4 ATR below for profit target. Alternatively, instead of placing a stop loss above the confirming candle's close, we can place it at 1 ATR above the high of the bearish engulfing. This one above the high, 1 ATR above the high of bearish engulfing pattern. The ATR value for this bearish candle, it's calculated as at 11 cents. This would provide a buffer in case of any potential retracement before the downtrend movement resumes. By using this information that you see here and the ATR value at 11 cents, then we can have this as a stop loss and this as profit target. So this is how you trade bearish engulfing pattern. Excellent example with 4 entry positions. Let's analyze the H&R block on a daily time frame where we can identify 4 potential entry position. The trend initially is going upward, followed by the first pullback. At the bottom of this pullback, we have 2 pin bar. The first one is bearish and the second one is bullish. Now, if you blend these 2 candles with candlestick mat blending, the outcome is a bullish hammer, suggesting a possible trend reversal from downtrend to uptrend. So this is the confirmation candle that closes, this bullish candle that closes above the high of the equivalent, which is that hammer, that bullish hammer. I have so many videos on candlestick mat blending. Please review them in order to understand this one much better. So you can put 1 ATR below for a stop loss, and we put 3, 4 ATR above the close price of this candle for profit target. You see the trend continue going upward for 7 days, and at the top of this uptrend you see this shooting star, and that suggests a possible trend reversal from uptrend to downtrend. Now the confirmation candle is this bearish candle that closes below the low of this shooting star. So you can exit the trade at the close price of this bearish candle, and we put 1 ATR above for a stop loss, and we put 2, 3, 4 ATR below for profit target. Now the trend going down, and at the bottom of this downtrend and this pullback, at the bottom of this pullback, you see this strong bullish hammer suggesting a possible trend reversal from downtrend to uptrend. Now this bullish candle is a confirmation candle that closes above the high of this hammer. So you can enter the trade at the close price of this hammer and put 1 ATR below for a stop loss and put 2, 3, 4 ATR above for profit target. Now the trend is going up for almost 7 days, for 3 days, and at the top of this uptrend you have this bearish engulfing pattern. Now this bearish engulfing pattern suggests a possible trend reversal from uptrend to downtrend. Now we have to look for the confirmation candle. This is a confirmation candle that closes below the low of this bearish candle in engulfing pattern. So you can exit the trade at the close price of this bearish candle, and we can put 180R above for a stop loss, and we can put 2, 3, and 480R below for profit target. So this is a very good example that you can have 4 entry positions. How to identify false breakout and enter trade correctly. Let's analyze the CAR stock on a daily chart. We identify a strong resistance level with nearly 5 touches, considering it as an area or zone rather than a simple line. At first swing high, we observe a bullish candle with its upper shadow breaking above the resistance level. Similarly, at the second swing high, we have a bullish and bearish candle, both with upper shadows breaking the resistance. As we move to the third and fourth swing high, the candle penetrates into the resistance level and then bounce back, which is a normal behavior. However, at the last swing high, we notice a different scenario. The first candle is bullish and break above the resistance level, closing above it. But the following candle is a bearish candle, opens above the resistance with an upper shadow that extends beyond the resistance level. However, it subsequently drops below the resistance and close below it, indicating a false breakout. In this situation, it is prudent to exit the long position considering the false breakout. Some traders mistakenly interpreting the breakout as a valid signal enter long position during this last swing high. However, shortly after entering the trade, they often get kicked out due to their stop loss order being triggered. Here we can exit the trade at the close price of this bearish candle and put 180R above for a stop loss and 380R below for profit target. So this is going to be our stop loss and this is our profit target. So this is how you can trade false breakout correctly. Recap and summarization. In this video, we cover key aspects of price action analysis. We started with introduction to price action and its importance in trading. Then we explore various candlestick patterns such as doji, engulfing pattern, hammer, and shooting star, and learn how to interpret them using real-world chart examples. Next, we discuss support and resistance level, including how to identify and draw them on a chart, and the significance of breakout and pullback scenarios. Trend analysis was also a crucial topic where we looked at identifying and confirming trends using price action and the role of trend line. Lastly, we introduce practical price action strategies with examples for entries, exit, and stop loss placement. We provide visual illustration to help you understand these strategies. Thanks for watching. We hope you find this video valuable for your trading journey. Remember to stay curious, disciplined, and keep learning. Don't forget to subscribe and share our channel to receive future video on time. Your support is greatly appreciated and happy trading. That's all, folks. If you like this video, thumbs up and subscribe. Thanks for watching. Take care and see you next time.